Okay, now moving on to the apartment list. We're going to talk about rent growth. We usually talk about this almost every week. Apartment list puts out a nice report, the National Rent Report, July 2022. We're not in July yet, but it's getting us ready for the next month coming up. So Matt, what's going on with rent growth? Rents are still growing? It sounds like
Elevated, definitely. It's not at 2021 levels, but if we kept it at 2021 levels, that'd be insanity. But we're still well above any other year than 20.
So we're at 17.5% was the rent growth in 2021. So now so far, 6 months through, we're looking at 5.4%. So kind of cumulative rent growth over the last 18 months. We're looking at 20, call it 24%. Total rent growth.
Yeah.
That's over 18 months. That's quite a bit, and we still have some room to go. But then the question is what we were talking about earlier, Matt, is are we seeing peak inflation, and does inflation really just drop out, or are we going to see elevated levels of inflation over a longer period of time, which I think most people think that we will, and so we'll see moderate rent growth, or are we going to get back kind of the historic norms? Because we're not too far off from where kind of a typical year is at, but I mean it's going to be at least double, I'd say, from your typical year. But the other factor is this is compounding,
Yep.
So it's 5% on top of the 17.5% from last year. So a $1,000 rent, 10%, that's $100. Whereas when it was $800. It was only 80, so we're talking significant increases. Nominally, the percentages mean a lot more on a nominal basis, which is what renters.
Yeah, it looks like in 2021 it was around 10% in July since the beginning of the year. Now we're about 5%, but in 2018 it was around 3%. 2019 2.3.
Yeah, 2020, negative. There was rent declines nationally. Some markets saw growth.
We could end up the year with 10% rent growth pretty easily, and I think that's just this. To summarize the rent growth for this year, I think it is going to be elevated. It's going to be a little bit more stable. I don't think it's going to be kind of hyperventilatingly high as it was in 2021.
Yeah. It's where is it going to be by really August?
Yeah.
I mean, because then it really typically flatlines. I mean, even in 2021, it flattened out. In typical year, you actually see some declines as not as many people are in the market for apartments. After August, everyone's already moved in. It starts getting colder. People make concessions, lower rents to kind of fill it up. That didn't really happen last year, but the bulk of the growth is going to happen it has already started. But we've got kind of 2-3 months of growth to see what happens, and that's going to be it. So do we hit 10? Good.
Yep.
We could hit. We could be at 8 or we could be at 9.
Yeah. I think the map of each market specific, national numbers are interesting, but the map of each market, and this is the chart that I wanted that I was thinking about too when I was talking about how we're at this kind of stable new level. You see how we are. 2021 looked like it was raising up to a peak and then it kind of fell down. Right now we are approaching an elevated plateau that's still higher than any other year before it, but it's not, there's not this exciting peak and valley that we saw in 2021.
Yeah, that's a good, and that's what we've been looking for is, typically, the rent growth started kind of declining after June and July, and you're still seeing, growth, but it started the rate of growth started tapering off, whereas in 2021, it really persisted throughout July, really even into August and September. And so we were wondering, are we going to have more of a traditional seasonality of most of the rent growth kind of March through July, or is it going to extend an extra month or two, and we're going to get another month or two of really strong rent growth?
Yep.
And maybe this is showing that maybe we are, maybe we're not. I don't know.
If it's an inflection, it could be an inflection towards stability instead of an tipping downward. That's what this chart at least seems to indicate.
I think there's also a feeling out there from a lot of managers and owners, property managers, that like, all right, we've pushed things a lot and people just need a break. Like maybe they can pay for it, but like everybody just needs a break.
Yeah.
And like, let's kind of slow down, absorb all this growth. Because again, like we've talked about, countless times, is you still have all these rents that are much lower than the market, and you've got a lot of rents to kind of move up, and you don't need to keep moving that market rent to increase income. You can just get everybody up to market and kind of see where you are. Now, the risk is, which a lot of people ran into, is you can be behind the curve a little bit. A lot of groups were in 2020 and 2021 because they just didn't believe that that type of rent growth was going on until they looked around. They're like, oh, geez, now we're $200 under market. And so, again, that's why I think the Gray Report's a great tool and resource to people in the industry, because you can kind of stay on top of it if you don't have time to, read, 50 reports a week. But trying to be ahead of it. But then it's also, are you using kind of anecdotes and kind of emotion? And like, I feel like people are at that point, which is probably a good thing to do as a human. But then at the same time, from, a business perspective is, what can people afford and where is the market? And, we saw that, rents have risen, but they haven't risen anything like, actual single family home prices have.
Yeah.
And a lot of other commodities, a lot of the makeup of CPI, rent, it hasn't, it's beat inflation, but, it's fallen behind some of those other kind of items that have increased, substantially. And so, we do live in a market-based, system. That's not necessarily kind of a real free market, but, we do have markets.
Yeah.
And that's kind of, you don't want to be behind. You don't want to be behind the market and leave money on the table. But, how do we also be, good, member of the community and not just, drill people's lives?
Yeah.
And it's like, hey, we're doing great right now. Let's just focus on what we've got and look for opportunities. But, rents have already risen by quite a bit.
Yeah. And, you're talking kind of about ground level experience and specific experience. And I mentioned, maybe looking a little bit at the trees rather than the forest. And this was one of the parts of this report in talking about the changes that have happened in the last 6 months. It is really interesting. Yes, stable, elevated rent growth is a big takeaway, but I have been taking a closer look at the shorter term growth over the past 6 months that they note in this report. Las Vegas, for instance, is among the leaders for rent growth since March 2020. But it has had the lowest rent growth in the past 6 months. Markets in the Northeast, on the other hand, are really catching up in 2022. Likewise, San Jose, which had the lowest rent growth since the start of March 2020, now leads the nation in rent growth over the past 6 months. Things are happening, and they're different things. I do kind of want to emphasize this, and just for a couple seconds, and dwell on this, because for the past 2 years, it seemed like I was seeing the same cities over and over on the top rent growth, whether it's month over month or year over year. The same cities, the same hot markets, either in the Sun Belt or maybe like Boise, were over at the top of the list. Yep. And now we're seeing a little bit more. Louisville is one of the ones that have grown the most over the past 6 months. There's been a lot of northeastern markets that have grown a lot recently. So I think that there is some of those really the larger markets people are maybe returning to. Maybe they're returning to kind of the New York area, or they're coming back kind of to the higher priced San Jose or San Francisco markets, whereas those got really hard hit early in the pandemic. So there might be not a snapback effect, but a little bit of a return.
There's some catching up to do. That's for sure. And then some markets have just grown to a point where they've kind of topped out too quickly. Yeah. So just some of the slowest markets for rent growth. Again, to see kind of Las Vegas on the same on this list, is interesting. But over the since March 2020. No surprise, San Francisco, San Jose, which is, near San Francisco, and then, Minneapolis has just been absolutely crushed. Yeah. And then Houston is interesting, as being one of the slowest metros, but that's been such a popular investment market. Mm-hmm. For a lot of investors and syndicators, it just hasn't been growing, nearly as much. But to your point, Matt, past 6 months, look at this list: lowest metro growth, Las Vegas, Jacksonville, Phoenix, Atlanta, Baltimore, Sacramento, Virginia Beach, Pittsburgh, Philly, Portland. Most of on that, not all, but almost everything on that list was like usually in the top for rent growth. So that switch at least has flipped.
We've said that. We said almost exactly this thing a couple weeks ago. Is how, in a land where inflation pressures are increasingly being felt, prices are starting to constrain people. People are responding to high prices with reduced demand instead of just paying them. The higher price markets seem like the most vulnerable. It's not like a tall poppy syndrome. It's just like that's the first to go.
Yeah. Yeah, the higher you climb, the further you have to fall. And this is a cool interactive map.
Oh. So my critique with this map is it goes from light blue to, which is the markets that have decreased, their rents decreased since 2020, to a dark kind of reddish orange, which is the strongest rent growth. They peak their rent growth at 40. There are plenty of markets on this list that are off the charts. There's not even a color-coded system that can record how much rent growth that has been seen in places.
Not as big of a gradient. If you're colorblind, it's a little tricky. It looks kind of like one of those colorblind tests that I consistently fail. But I mean, and so this is March 2020 through May 2022. So this is over a just around basically 2-year period, a little more than 2 years. Basically, since the pandemic started. But Carmel, Carmel, 35% rent growth. I mean, even Chicago. Chicago's pretty low. It's only 6% rent growth. But then over here, South Bend 18.7, and then the Florida markets have just been gone crazy.
I was looking for. I think there was
for Jacksonville, Tallahassee's 25%.
Oh, whoa.
Yeah, what is that?
There was like a Bradenton, Florida, at 52%. 52.4% rent growth. I think there is a similarly high one, like Clarksville, Tennessee is also incredibly high.
49%.
I mean, these are off the charts.
Knoxville, 47. Chattanooga, only 27. Bowling Green, 26. Lexington, 26. Cincinnati, 16. Bloomington, 18. Fort Wayne, 24%.
Well, Carmel and Avon, they're doing incredibly well.
Carmel 35, Show Avon, Indianapolis 20, Greenwood 29. Yeah, it's
a lot of submarkets that are doing incredibly well. I almost think it's time to start measuring it year over year instead of maybe since the beginning of the pandemic, because we're a changed landscape.
Agreed. I mean, I understand why they're doing it. It's interesting to see. I think you need to have both. It is like a kind of a notable time period of what is the difference. Yeah. But I don't disagree. And again, Avon 40%.
Yeah.
And again, not to kind of talk our own book, but most listeners, some are from Indy, so they know. But a lot of people haven't heard of Avon, Indiana.
Well, even people in Indianapolis don't know that doesn't come up in conversation as often.
Suburbs, it's typically your Carmels and your Fishers and the northern suburbs. 40% rent growth. Since the pandemic, 20% just year over year. And again, this is what we tell people. Many investors love the Sun Belt because of all this population growth which has led to rent growth. But the cap rates are so low, so you're not getting hardly any cash flow.
Yeah,
you can go to a market like outside of Indianapolis, go to suburban Indianapolis like Avon. You're going to get the same growth, and you're going to get a lot higher return.
Yeah,
because you're being able to get your basis is just so much better. You're putting the same kind of debt on it. Now, the overall total return often ends up being relatively similar in the Sun Belt versus the Midwest. Maybe you get a little bit more appreciation, you get a little more cap rate compression, which involves some speculating, but in the Midwest, you just get the cash flow.
Yeah.
Because you're getting a better basis going in, you've got the good growth, it's solid employment base, solid population growth. So it just leads to a lot of cash flow. It's a different return profile that I think is more balanced between cash flow and upside, rather than I'm just going to speculate that there's going to be so much price appreciation that somebody's just going to pay me a lot more at the end of the day, which they have been, they probably will, but it's just kind of what type of risk and return profile are you looking for? And again, that's why the Midwest is just, for us, it's a sweet spot for all of the things we just mentioned, and that we know it.
Yeah.
We're here.
It's got my favorite thing, stability.
Yeah, much less volatile.